Hello, I'm Jerry Romine, and in this video I'll be teaching you the long call option strategy with a detailed example and walkthrough so you can see and understand how to trade this option strategy. My goal is to keep this video under 5 minutes and everything is free so you can just sit back and follow along. I believe we learn best by doing, and this video will be a hooked on phonics style where I walk you through this option strategy using TD Ameritrade's Thinkorswim platform. But if you use any other platform, the process will be similar. Let's go over option basics, and this will help us with any option strategy.
A call option gives the option holder the right, but not the obligation, to buy shares of the stock at an agreed upon price on or before a particular date. A put option gives the option holder the right, but not the obligation to sell shares of stock at an agreed upon price on or before a particular date. The strike price is the agreed upon price at which the stock will be bought or sold, and the expiration date is the contract date that the option contract will expire. What is a long call option? Buying a call is a simple bullish option strategy that gives the buyer the right, but not the obligation to buy the underlying stock at the agreed upon strike price. Our goal is to profit from an expected short-term price increase in the stock price, and the maximum loss is the price you pay for the option, and this creates what's called a net debit, and this is how much you pay when you buy that option. Now, I normally like to buy a call option with around a 0.7 delta, and you'll see that come into play in just a little bit.
We learn best by doing, so let's walk through a detailed example, and we'll start with a sample Discord trade alert which gives us all of the information to buy a call option.
I consider all options risky, so I always put that in. And then we've got a buying a forward call option, bull positions, profit if the stock goes up. So this lets us know we're expecting the stock to go up. Our expiration date is going to be 16 September of 2022. Our strike price, we're going to buy the $14 call at $3.60. Our break even is anything above $17.60, and that would represent a 5.7% movement in the current stock price. And break even is defined for this strategy as the strike price plus the premium paid. So our strike price is $14, our premium is $3.60, and that equals $17.60. Our maximum profit is unlimited. Our maximum loss is the cost we pay per contract, which is $360, and that's because $3.60 per share times 100 equals $3.60. Our reasons to buy, I always like to include the reasons why I'm buying, and that helps myself and everyone, and it also helps you become a better trader. Then we've got a recap on our strategy, and I like to say that the maximum loss is the price you pay for the option, and this creates a net debit. So this means when we buy this option, we have to pay money. And then I normally like to buy a call with around a 0.7 delta, and just remember that for later. And then we've got a quick look here at our profit graph where we can see we win if it's above 1760 at the expiration date, and we lose if it's less than that.
Now let's jump into a real trading platform, and I'll show you step by step how easy it is to buy a call option.
We're now in Thinkorswim, and we're looking at Ford Motor Company, and for whatever reason we believe that Ford is going to go up in value and we want to buy a long call. All we do is come up over here and we're going to click on the trade button, and this brings us up to our option chain, and then we need to pick which month we want. We're going to go ahead and go several months out, so we're going to drop down here to 16 September. We click on it, and here's our different options, and then this side is our calls, this side is our puts, and then what we want to do is we're going to buy the $14 call. So all we do is come over here and we're going to click on $3.60 to buy it, and when that happens it pops up our order entry screen. This is a single, we're buying one. It's the 16 February Ford $14 call. The price is $3.60, and this is a limit order for the day. Now all we have to do is click on the confirm and send button, and this brings us up to our order confirmation dialog box, and this is a quick summary of the entire transaction. So we've got Ford, it's currently trading at $16.65. Our order description, this is what we're buying. Our break-even stock price is $17.60. Our max profit is infinite. Our max loss is $3.60, and this gives us all of the information. Then all we do is hit that send button, and then that order goes in, and right now you can see it's waiting to buy it. Currently the markets are closed, so this order won't go through, but that's all you have to do to enter a call option.
And that's how you buy a long call option. Thank you so much for watching. My name again is Jerry Romine, and I'm an active investor, plus I have a Discord where I provide stock and option trading alerts, and that link is below if you want to check it out. If you enjoyed this video, please leave a comment down below letting me know what you liked about it or what you would like me to cover in future videos. This video is part of an option series I'm creating, so be sure to subscribe so you don't miss the next video. Thanks again, and I hope to see you soon.